The U. Debt ceiling is a legal limit on how much the federal government can borrow to pay its bills. It is set by Congress and has to be raised periodically to avoid defaulting on the nation's obligations. However, raising the debt ceiling has become a political issue that affects the confidence of investors and consumers in the economy and the dollar, which in turn influences the demand and price of oil. Oil is a global commodity that is traded in U.S. When the dollar weakens, oil becomes cheaper for buyers using other currencies, which boosts demand and pushes up prices. Conversely, when the dollar strengthens, oil becomes more expensive for foreign buyers, which reduces demand and lowers prices. Therefore, any uncertainty or risk around the U.S. debt ceiling can have an impact on the value of the dollar and the oil market. For example, in May 2023, oil prices slid about 2% on Thursday as a political standoff over the U.S. debt ceiling stoked recession jitters in the world's biggest oil consumer, while rising U.S. jobless claims weighed on sentiment and a stronger dollar pressured oil too. On the other hand, oil prices ended at their highest in over a week on Wednesday, with prices finding support as comments from President Joe Biden fueled expectations that the U.S. will reach a deal on the debt ceiling. The U.S. debt ceiling also affects the confidence of investors and consumers in the economy, which influences their spending and saving behavior. When people are optimistic about the future, they tend to spend more on goods and services that require energy, such as travel, transportation and heating. This increases the demand for oil and drives up prices. When people are pessimistic about the future, they tend to save more and cut back on discretionary spending that uses energy. This decreases the demand for oil and pushes down prices. For instance, in October 2022, when the U.S. government was on the brink of defaulting on its debt obligations due to a deadlock in Congress over raising the debt ceiling, consumer confidence plunged to its lowest level since 2011. This dampened the outlook for oil demand growth and weighed on prices. In contrast, in June 2023, when President Biden and top congressional Republican Kevin McCarthy agreed to negotiate directly on raising the debt ceiling and avoiding an economically catastrophic default, consumer confidence rebounded to its highest level since 2021. This boosted the outlook for oil demand growth and supported prices. In conclusion, the U.S. debt ceiling is a political issue that affects the confidence of investors and consumers in the economy and the dollar, which in turn influences the demand and price of oil. Depending on how the debt ceiling negotiations unfold, oil prices can fluctuate significantly as a result of changes in currency exchange rates and consumer spending patterns. The U.S. oil inventories and production data reflect the supply and demand balance of the market and how they impact the oil prices. In general, when the inventories are high and the production is low, it means that there is more supply than demand, which puts downward pressure on the oil prices. Conversely, when the inventories are low and the production is high, it means that there is more demand than supply, which pushes the oil prices up. The U.S. Energy Information Administration, EIA, publishes weekly reports on the U.S. crude oil inventories and production data, as well as other petroleum products such as gasoline, diesel, jet fuel, and propane. These reports are closely watched by traders and analysts as they provide insights into the current and future trends of the oil market. According to the latest EIA report for the week ending May 5, 2023, the U.S. crude oil inventories increased by 5.0 million barrels from the previous week to 467.6 million barrels, slightly below the 5-year average for this time of year. This was the biggest weekly increase in 11 weeks, and it exceeded the market expectations of a 0.917 million drop. The report also showed that the U.S. oil production increased by 100,000 barrels per day to 12.2 million bpd, the highest since October 2021. These data indicate that the U.S. oil supply is rising faster than the demand, which could weigh on the oil prices in the short term. However, other factors such as global demand recovery, OPEC+ output policy, geopolitical tensions, and weather events could also influence the oil price movements in the long term. Therefore, it is important to monitor not only the oil inventories and production data, but also other indicators of the global oil market dynamics to get a comprehensive picture of how they affect the oil prices. The global economic outlook, especially in China, the world's largest oil importer, affects the demand for oil and how OPEC+ responds to the changing market conditions. China's economy has been recovering strongly from the COVID-19 pandemic, leading to a surge in its oil consumption. According to the International Energy Agency, IEA, China's liquid fuels consumption is forecast to be 700,000 barrels per day, B/D, higher in 2023 compared with 2022. This growth is seen as the main driver of an expected 1.5 million barrels per day increase in global oil demand this year to 100.9 million barrels per day, a 430,000 barrels per day jump from last month's estimate. China's oil demand hit a record high in March, as its industrial activity in travel rebounded. Bookings for trips abroad during the upcoming May Day holiday also point to a continued recovery in travel to Asian countries, although long-haul airfares have soared and flights are limited. The IEA expects global oil demand this year to rise to a record 101.9 million barrels per day, 2 million barrels per day higher than last year's figure. However, China's economic outlook is not without risks. The country faces challenges such as slowing property market, rising debt levels, environmental pressures and geopolitical tensions. These factors could weigh on its oil demand growth in the medium term. Moreover, China is also pursuing a low-carbon transition that could reduce its reliance on fossil fuels in the long run. On the supply side, OPEC+, the alliance of major oil producers led by Saudi Arabia and Russia, has been adjusting its output levels to balance the market and support prices. In April, OPEC+ agreed to deepen its production cuts by 2 million barrels per day this year, despite concerns that China's economic rebound could drive higher demand. The move was seen as a surprise by many analysts and traders, who expected OPEC+ to ease its curbs gradually as demand recovers. OPEC+'s decision has boosted oil prices, which have risen by more than 40% this year to above $80 a barrel. However, it has also angered Western leaders, who fear that higher oil prices could hamper their economic recovery and fuel inflation. It has also provided extra revenues for Russia, which is engaged in a war against Ukraine. OPEC+ faces a delicate balancing act between meeting the growing demand from China and other developing countries, and avoiding a supply glut that could depress prices and hurt its revenues. It also faces competition from other producers, such as the U.S. shale industry, which could ramp up output if prices remain high. OPEC+ will meet again in June to review its policy and decide on its next steps.